Hello, hello, everybody. Hope everybody's doing great, doing well today. Raza Khan here. Very excited to have you on board. Today, we are talking about a very, very exciting topic, which is our new acquisition of the Westin Hotel. So, just in the interest of time, we have some people kind of trickling in slowly but surely. It's 6 o'clock. Today is Wednesday, July 29th. And just like that, the seventh month is gone just like that. It seems like yesterday I was, popping some champagne, some bottles of champagne for New Year's Eve, and here we are. So very happy to have you here. We're going to kick off the presentation in about 2 to 3 minutes. Uh, Typically, people have some trouble signing on if they're not frequent users. And I'm very excited. We are very excited to share everything with you in a moment. So we're gonna mute ourselves and we're gonna wait for the people to trickle in, and in exactly 2 minutes, we will kick it off. Thank you very much. Hey everybody, hope everyone can hear me okay, see me okay. Before we begin, if I could just have a show of hands to show me or let me know that the sound is okay and the video is okay. Uh, Thank you, thank you, thank you. Thank you very much, everybody. Really, really appreciate it. Hope you're all having a great summer. July, special month, of course, the 250th anniversary of the founding of the nation. Momentous occasion, a lot going on in the world. The stock market is still soaring. The Fed just had their meeting today and they decided to hold off on any cuts or any announcements. They just decided to hold the rate steady, which is great. It's not bad news and it's not good news either. But we're very excited to have you here today. We have lots of people here. Thank you for joining. Really, really appreciate it. Thank you for being here with us. So we are very excited to share what's happening on our end at Qila Capital. I see a lot of familiar faces that are dialing in, and some of you have talked to many times. Some of you haven't talked to in a while, and some of you I just met recently. So thank you for joining, and thank you for making the time. Um, a lot going on. We've been on a great acquisition run lately, as you may know. In the last 10 to 12 months, we've done three acquisitions, all select service properties, all Marriott properties. If you've been following me along for a long time, you've heard me talk about the Alofts before. The two Alofts, one at UTSA, University of Texas at San Antonio. And of course, the second one is the airport property. But recently, we've done another acquisition, which is the Town Place Suites at the San Antonio Riverwalk. Now, the Riverwalk is a special place because it's the most visited landmark in the state of Texas. A lot of people don't know that. And that's where the Alamo is located, of course. A lot of history there. But the reason why we're here today is because we are doing our most exciting acquisition to date. And once in a while, something comes along your desk that makes you do a double take. It makes you scratch your head. It makes you ask other people, "Am I going crazy, or does this look really that good?" And that is what's happening right now with our newest acquisition, which is a 326 room full service Westin hotel in San Antonio, in the northwest corridor of San Antonio, which is the most you could say, GDP rich area in the city, and the most exciting place to be. So we're going to talk all about it today. I am very excited to co-host this webinar with Mr. Kim Andereck. He'll tell you about himself in a moment, but as you know, we've been beefing up our operations and our team, and we had to bring in an expert to provide us with guidance and stability, and that's where Kim comes in. He's our Chief Hospitality Officer. And as you know, we have multiple divisions in our company. One of them is focused exclusively on healthcare. And then we also have hospitality, which we're expanding. So that's where Kim comes in and adds value. Before we kick it off, Kim, do you want to say a few words?
First of all, I'm happy that you've joined us. This is a very exciting day. We're going to share some information with you that is compelling. As Raza said, deals come across your desk, and sometimes they're good, sometimes they're bad, sometimes they're ugly. And then sometimes they come across and it just sounds too good to be true. This is a deal you can evaluate for yourself, but it's an opportunity uncovered that makes so much sense. So I'm excited to have you learn a little bit more about it and ask any questions you have. This is an open book tonight.
That's right.
Welcome.
Thank you very much for that, Kim. So, ladies and gentlemen, we're going to kick it off, and I will be sharing my screen as I normally do. And I'll complete the presentation, and then we'll have a little open forum towards the end where you can ask us as many questions as you like. That's how we typically do these. And with that, I will go ahead and share my screen. Okay, can everybody see my screen? If I could just have a quick show of hands. Perfect, perfect. Thank you, thank you. Thank you very much. Lovely, lovely. All right, here we go. So the title for this presentation is The Perfect Storm, because that's how we think this deal is. This is the acquisition of a 326-room full-service hotel in San Antonio. There are two swimming pools, one indoor, one outdoor. There's a full convention center in the back here that it has a ballroom for 1,500 people. And it's 17 stories tall, and with a food and beverage area, a restaurant. There's a lot of value add opportunity, and it's a lot of it is to do with COVID, which we'll talk about in a second. The entire parcel is about 6 acres, which is great size as well, and it's right off the I-10, which is one of the largest, one of the longest freeways in the nation. Before we begin, of course, our legal and compliance team requires us and reminds me every time to bring this up. We are a 506c company. That means we're regulated by the Securities and Exchange Commission, and we work with accredited investors only. Everything that we're talking about in today's presentation is educational, and sometimes there may be an opinion shared here and there. And opinions are like, what? Everybody has one. So just take that with a grain of salt. Of course, we're biased and we have great conviction. So the agenda is very simple. We're going to talk about I'm earmarking about 45 minutes, but I think we'll get it done sooner than that. We don't want to bore you with the details. We'll just leave more of a period towards the end for Q&A. Who we are, a lot of you already know us, which is fine. We're just going to get through it quickly. We're going to talk about what's happening in the market, the state of commercial real estate. Very important. Of course, the perfect storm. Not every distressed deal is a good deal. And what is our criteria to identify exceptional opportunities? And then we're going to actually do a breakdown of the deal. We're going to tell you about what we see in this, how we're underwriting it, what needs to be done, etc. And of course, we're going to talk a little bit towards the end about how do 1% of the investors invest and what makes this a strategic opportunity. And of course, towards the end, we'll have a Q&A session. Any questions you have, please save them and we'll be happy to answer them for you. If you are new to our company, we are Qila Capital. The word Qila in many Eastern languages means fortress or fortification. And we felt like it would be a good four-letter word to describe what we believe in, what our philosophy is, and that is to be ultra conservative, invest in boring, cash flowing assets. We don't do any rocket science or brain surgery. We are old school conservative people. that take advantage of the oldest wealth generation tool in the world, that is real estate. Um, we have about 235 million in assets under management, and of course, that number is growing in multiple ways as we stabilize our existing portfolio of properties and acquire new properties, and more importantly, our healthcare portfolio that performs exceptionally well. As an outlier, really. Um, we are located in San Antonio, Texas, as you know, or as you may or may not know. We're exclusively focusing on a unique tertiary market, which is South Texas. Okay. We believe you have to look for great opportunities to make money, and a lot of times you got to look in places where other people are not looking. And that's where South Texas comes in. It's one of those incredible regions. Our philosophy is very simple. It's to make our investors more money and make them live better. If I could summarize it in four words, I would say earn more, live better. And we do that in multiple ways. We do that in providing cash flow, growth, and of course, a couple of other unique things we do. We charge no fees of any kind, and we actually pass on some of the hotel benefits, the discounts and benefits to our investors, which results in them saving a lot of money and traveling more and staying at nicer properties, which they love. Moving on. This is what our team looks like. We have expanded, of course, and some of these people you may have talked to. If you visited us, you may have met Harry. You may have talked to Priti, who's our investor relations person. We're not going to talk too much about our team because we don't like to talk about ourselves. We'll share this deck with you, and we're happy for you to look at it later. Um, Moving on, what makes us unique, like I said, is we focus on two uh, industries or two asset classes. One of them is healthcare, the other is hospitality. The reason why we gravitate towards these and not traditional real estate like multifamily or office, industrial, is because we like to roll up our sleeves and practice our entrepreneurial excellence or our vision. We're entrepreneurial folks. We like to get to work, and hospitality and healthcare are industries that are more operationally intensive. And the better of an operator you are, the more likely you will make money and you'll do well. You'll make more money than other competitors or other operators. And that's why we gravitate towards these asset classes because we have the ability to turn them around to extract more cash flow and therefore increase the value. And as that's how it works in commercial real estate. So these are the cities that we're focused on. We are kind of, like I said, focused on the South Texas region. Austin is a city that we're expanding our wellness and recovery spa brand into. It's not ideally a great market for real estate, especially right now, but typically these are the cities that we're focused on. And our portfolio includes brands like Marriott, IHG, Hyatt. These are our emergency rooms, McAllen Emergency Room, Laredo Emergency Room. We're in the process of building a purpose-built micro hospital in Brownsville, which is the fastest growing city in the nation right now. This is what the hotel portfolio looks like currently. The Staybridge Suite, it's in Laredo, the Aloft, the two Alofts that we own in San Antonio. One of them, this one at UTSA, we acquired in November of last year. The airport property we acquired in March of this year, and the Town Place Suites is our newest acquisition, which was in June, early June. And these other properties, the Staybridge, the extended stay, and the Courtyard, we've had for a while. Two of them are in Laredo. This one is undergoing a conversion right now to a Hyatt Studios, which is one of the new brands that Hyatt has recently introduced for select service and extended stay models. So typically we focus on the select service brands because they're more profitable. There's less work required. There's less staff, all that stuff. But sometimes a really, really good deal comes along, like this Westin, which we'll talk about in a second. This is our healthcare portfolio. So we have the Laredo Emergency Room. We have the McAllen Emergency Room. This is the ground up micro hospital With this micro hospital, we also have a retail plaza on the side, which we're also going to be operating. And we're only doing it because we have the land. Typically, we wouldn't go looking for deals like this. We have Optimal Wellness and Recovery, which is a wellness and recovery spa in Laredo. It does really, really well. And we're expanding it to other markets right now, like Austin and San Diego. And then these are a couple of other healthcare related businesses. One of them is a hospice end of life care company. One of them is a border equipment. It's the medical equipment company. Okay, moving on. So, what makes us unique? Again, we're not going to talk too much about this, just kind of glancing over it. Proven track record. Our properties perform really well. Our businesses perform really well. I tell people our healthcare portfolio generates over 25 million EBITDA a year, which is incredible. Those are incredible numbers. Like there are private equity groups that are interested in buying us out. And when they look at it, they scratch their head and they ask us, how did you make it happen? Because we're good operators. We know how to market our businesses and our properties. We ultimately like to create a really good experience for the end user, for our hotel guests, for our patients that come to our facilities. And that results in loyalty and that results in recurring revenue and more people coming in. Proven strategy. We have a cash flow first strategy. We only like to go into deals where there is a lot of value add and cash flow potential. Thirdly, we put our investors first, and we do that in multiple ways. We have a 506c fund being regulated by the SEC. We go above and beyond in multiple ways, like passing on benefits, charging no fees, which 90% of operators typically do. Sponsors, I should say, fund managers. And innovation. We believe in disrupting the world of alternative investments. We truly believe that people that work really hard, like you have a nest egg or a retirement fund, or you're saving for a rainy day, your kid's education, whatever, it deserves love and respect. And you deserve to have access to opportunities that you normally would not have. And we believe in democratizing those opportunities in alternative investments, such as hotels, such as healthcare, et cetera. And doing it in a way that people don't get taken advantage of in fees and all the other stuff. So let's jump into the meat and potatoes of the presentation now. So what's happening in commercial real estate in 2026? Well, to summarize it for you, there is a great deal of distress out there. There are a lot of distressed sales, foreclosures, receiverships, auctions taking place all across the nation, especially in the state of Texas. I mean, the state of Texas is faring relatively well compared to other states. But even in Texas alone, there were $900 million of assets that were auctioned off in the month of July. So that should give you an idea. And I'm not talking strictly about hospitality. I'm talking about office. I'm talking about multifamily, industrial, land, you name it. And the reason why that's happening is because, and I've been saying this for a long time, if you've attended my previous webinars before, I have a term that I coined, which is we are in a post-pandemic hangover. We're waking up. We were drunk on cheap capital during COVID, on low interest rates, a lot of stimulus, a lot of quantitative easing, the Fed printing money and making debt very accessible to people. And now the chickens are coming home to roost. Of course, as you know, in 2020, COVID happened, and the Fed's immediate response, and not just the Fed, all the central banks around the world did something similar. They injected a lot of capital, trillions of dollars into the economy. In 2022, the Fed rate went up. It drastically went up because they realized that, okay, things are getting way too hot. We have to cool it down. And they do that using the only tool that they have at their disposal, which is the Fed rate, the interest rate, the overnight lending rate. When the Fed tripled the rates during COVID, there were a lot of loans that were originated because this is the land of capitalism, right? People are always growing their portfolio. They're borrowing money, they're deploying money, they're taking on construction projects, etc. So when those 2-3% interest rates were originated during COVID, that was a great time for people. But a lot of those loans were 5-year loans, and exactly. And There's a CMBS program, commercial mortgage-backed security loan. And by the way, I see Kim smiling there because Kim is one of those people that has one of those really sweet loans with his hotels. 2%, 3%, right? Yeah.
2.99 at the two hotels.
Exactly. So there are a lot of people like Kim, but Kim actually has a sound strategy and his hotels perform well. But there are a lot of people that took out these loans at 3% that are not great operators. They just did it because they were greedy or they were looking to expand their portfolio. And now, 5 years later, those loans are being refinanced and they're coming up for a renewal. And if you are, yes, in 2027, Kim, is that what you're saying?
7% now, six and a
Exactly.
half, 7%
Exactly. And
refinance.
7% if you're lucky, by the way, because there are some people paying a lot more, 7.75, 8%. If you don't qualify for a good loan program, you have to go to the hard money lenders, which charge you 10 to 12%. So it's not a great time for those people, and we feel bad for them. But of course, this is the market. Some people are on the buy side and some people are on the sell side. And we're on the buy side and we're taking advantage and we're getting really good deals right now. So like I said, now these loans are being refied, and the terms and the interest rates just do not support the original capital stack. Okay, if your debt service cost goes up, it triples. How are you supposed to make money, right? So that presents us with a generational opportunity to invest. Okay, uh, in in the form of the Fed rate being high and these COVID maturities coming up for renewal. A lot of people are forced to sell. And if they're smart, they're selling on their own accord. If they're not, if they're stubborn and they think they can do better and turn it around, sadly, the bank takes over and they force sale the force sell the property. And that's what's happening right now. And then last but not least, a lot of times people refied their loans or originated loans and they said, let me make a little bit of cash. I'll get to the property improvement later. As you know, in the hotel business, there is a franchise requirement known as the property improvement plan, the upgrade. And it's not just in the hotel business, it's in many franchised businesses, McDonald's, Burger King. Like, McDonald's look different than they did many years ago. Pizza Huts looked different many years ago, and I kind of miss the old Pizza Huts from the 90s, to be honest, with the lanterns, but not the lanterns, the chandeliers on every table. So similarly, the hotel business, you have to do a PIP every 7 years. You have to bring it up to brand standards. You have to replace the mattresses, the beds, furniture, lobby, freshen up the facade of the building, inside, outside, carpets, bathrooms, you name it. It's an extensive process. And now we're finding a lot of these hotel operators that are in the business and they're being forced to sell their property or they're selling it on their own accord. Those people, a lot of them have not completed the PIP because that's a major capital expenditure. And it's hard to make ends meet, let alone pump millions of dollars into the property. And what that does is it creates a double whammy for us, for buyers like us. We come in, not only do we get a sweet deal because of the heavily discounted prices, but we also get a value add opportunity where if we take on the PIP and we complete the vision and transform the property, and then we can charge more money and make more money, more revenue, room revenue, entertainment, food and beverage, convention center, etc. So it's a great time to be on the buy side and to be an investor right now. And congratulations, you're here right now. You have cash that you want to deploy. You're doing a lot better than most people are that are on the sell side right now. Moving on, just to give you an idea of what the delinquency rates are like, this is some data that I pulled today, and it was generated in March, and that one was generated. The second one, the right one, was in towards the end of last year. I think it says right there, November 30th. So this is the delinquency rate, and as you can see, it's kind of going up. And this is not sector specific. This is about commercial real estate, specifically the CMBS program, the commercial mortgage-backed security loan, which is a special loan that doesn't have recourse. which is where a lot of these deals are coming from because the owner has no personal guarantee. They can just give the keys back to the bank and say, God bless you. This is not my problem anymore. It's your problem. So this is the overall state of what's happening in the market. As you can see in January 2026 and March, you can see we're at an all-time high in delinquency, overall distress and delinquency rates. I mean, we kind of hit it a little bit more towards in July, and then it kind of went up again. But things are not looking good for a lot of people, but they're looking good for us, so which is a good thing. And this is a breakdown of all the different asset classes. Of course, office is the worst one, sadly, because not only office is suffering from the delinquency and the distress, it's also suffering from a post-pandemic disruption where more people are using Zoom, and we're all using Zoom right now, as you can see, and more people than ever are working from home and traveling and the AI disruption, whatnot. So office, of course, is the worst. But hotel is number two, as you can see, or sorry, number three, right after multifamily, 10.3. So there are a lot of great deals to be had. That is the summary. If you can take away anything right now from this presentation and conversation, there are great deals to be had. There's a little window of opportunity, which is not going to last very long. Soon enough, a lot of deals like this, the sweet deals will disappear. And then the market will absorb it. The rates will come down eventually, I hope. But in any case, the timing is going to go away. The CMBS, the renewal timing is going to go away. Okay. Now, let's talk about the anatomy of a good deal. What do we look for as expert operators? What do we look for in a deal? Number one, the location. Of course, the old adage, location, 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 right? It's important, of course. Being close to regional drivers and demand anchors, it's important. Sorry about that. I got a little, from my camera, I got a notification. Coming back to this. So the second thing is demand drivers, not just relying on tourism, for example. Always hedging your bets, always protecting your back, right? And that's what smart operators do. We have properties, as you know, that are backed by secondary demand drivers. Three of our hotels are airport properties. One of our properties is a military properties located right next to the Lackland Air Force Base. And we have one property right next to the college campus. So all the parents that are dropping off their kids or kids that are moving, students that are moving in and out, they get to stay at our property. Tourism, and then medical travel. So this Westin hotel that we're looking at is located right next to the medical center where there are 6 major hospitals, including the largest VA hospital in the nation. As you may or may not know, San Antonio is the largest military city. It's actually nicknamed Military City, USA, and the largest VA hospitals here. So we have a lot of veterans that come from out of town or different cities like Corpus Christi and South Texas just to see their doctor. Number three, replacement cost. And you know what? I'm just going to rewind for a second. Kim, Kim also has a portfolio of his own properties. Kim, could you tell us about your properties and the demand drivers? I know that you benefit from the government business, so if you want to tell us about that.
Yeah, I own 3 hotels in Cheyenne, Wyoming, which people say it's in the middle of nowhere, but I say it's in the middle of everywhere. It's one of those potty break towns that's located west of Chicago, Des Moines, and Omaha, east of Salt Lake City, Sacramento, and San Francisco. But when you're heading west, you leave Lincoln, Nebraska, it's 600 miles to Cheyenne. And if you don't spend the night in Cheyenne, it's 600 more miles to Salt Lake City. Coming back, it's the same way. It's like an oasis in the middle of a lot of windshield time. Secondly, it's the state capital of Wyoming. So we have an influx of government people, lobbyists that come in for the legislature to lobby for their special projects, etc. We have tourists going to Yellowstone Park and Grand Teton. I mean, there's a steady flow of traffic generators in this area that was overlooked 20 years ago. My Marriott Spring Hill Suites was the first Marriott hotel in the state of Wyoming. And that opened in 2008. This just shows you how it was bypassed and overlooked. Today, we have two Hilton branded hotels, and we have the only two Hilton products in Southeast Wyoming. I think there's only 5 Hiltons in the whole state, but we get the benefit of the 260,000 members of Bonvoy that want to stay in a Marriott and the hundreds of millions of Hilton Honors members that want to get their points. And the beautiful part is a lot of these people are traveling courtesy of Uncle Sam. It's not their money.
Yeah.
They want their points. They don't care what the rate is because they're going to put it on the expense report. So these are things that you look at demand drivers and location and you say, there's something here that nobody else has looked at. I've got my money in the ground out there, probably 40, $50 million worth of real estate and hotels out there. We put our money in the ground 18 years ago and we've continued to grow it. So this isn't what we're talking about with these anatomies of good overlooked deals. If you take the leap and look at the traffic generators and the costs going in, et cetera, you think, boy, wonder why nobody thought of that before.
Mm-hmm. Thank you very much for those insights, Kim. And last but not least, the last point is current and future performance. So one of the things we look at is how much is a property doing, how is it doing, how much money is it making, and how is it being operated? Is there an opportunity for us to come in and just tighten it up, run it leaner and meaner and make money? Or do we have an opportunity to grow the revenue further? And that, of course, in turn, increases the value of the property, which is called value add. Okay. Now let's talk about San Antonio for the folks that are not from around here, and we have a lot of people on this call that are from all across the nation. And for you may or may not know this, but San Antonio is the sixth largest city in the nation. It just became the sixth largest city in the nation in terms of population. There's a lot of economic activity happening in the state of Texas. It's probably the #1 state that's benefited the most after the pandemic in terms of economic development. In San Antonio, we get 39 million annual tourists, and that's no joke. That's a lot of people. And there are a lot of people that come to the city that we don't even see because they're coming for military purposes. They come in, they go to the base and they spend their time in the base and, off-base housing, and then they, leave, or they get trained here, etc. So we're doing well. And of course, the Spurs made it to the finals this year. If you're a basketball fan, you have to come visit us when the next season starts. Wembanyama is going to be a force to be reckoned with. And we're very excited about hopefully getting some more rings soon. But there are a lot of great things happening here. So the airport, the San Antonio airport is opening up, is undergoing a $2.5 billion expansion. It's still one of those cities that hasn't had, you could say it hasn't taken flight yet. It's a major city. It hasn't had its moment yet. It's the second most affordable city for when it comes to cost of living in the nation. There's a $2.5 billion airport expansion happening because the old airport is still pretty small, and a lot of people are moving in and out. All the carriers, the major airline carriers, have expressed interest in expanding their routes, but the airport cannot physically accommodate more flights. That's why they're opening the new terminal. And recently, we have three major Fortune 500 companies, and I'll let Kim talk about that in a second. But Toyota has a plant here, and they just announced the newest plant, which is going to be in San Antonio as well. And all the Toyota Tacomas are currently built in Mexico, but of course, the with President Trump's tariffs, a lot of the automakers are opening plants and they're coming to San Antonio to build a Tacoma. Kim, do you want to talk about the Fortune 500 companies?
Yeah, so one of the exciting things about this Westin, we're located directly across Interstate 10 from USAA, which is the big insurance and financial giant,
Yep.
ranked number 49 in the Fortune 500 companies of the highest revenue, um, for the high revenue. And then at the next exit up, Valero Oil, which is oil exploration, retail, convenience stores, refining, etc. They're number 96 in total revenue on the Fortune 500 list. The University of Texas, San Antonio, two exits up, 42,000 students, faculty, or parents, etc. I mean, this is a tremendous area because within 10 minutes, we've got, 500,000 people that are, going in and out of these businesses and colleges. And then last, I'll let you speak to it, Raza. The medical center is a mile and a half west of this location with 6 major hospitals, all kinds of specialists, etc. If you get sick in Texas, South Texas anyway, you come here or you don't get the care that you need. When you come in, your family wants to come visit, spend 2 or 3 days while you're getting your appendix taken out. We're a hotel that's in very, very close proximity.
That's right. Thank you very much, Kim. I ran out of space on my camera. That's why I'm just turning it back on. Give me 1 second. Here we go. Okay, perfect. So this is a great place to be. That's the gist. Let's talk about the exciting part now. Okay, I know I kept you waiting. Thank you for your patience. Let's talk about the Westin. The Westin is, as you know, a premium brand. It's considered a a full service brand under the Marriott Bonvoy family, including Sheraton, including Marriott. And of course, there are other brands that have their own full service brands. Intercontinental Hotel is under IHG. Hilton, the actual Hilton brand is Hilton's brand. And we're excited about this one because we'll talk about this in a second, but our basis, the way we're getting this opportunity is just so superb. The buy is so superb that it's phenomenal. So 326 rooms located in the northwest corridor of San Antonio, where we have all the things that Kim mentioned, and it happens to be the only full service hotel in the northwest corridor. And that is the most high-end area. There's this place called the Rim, La Cantera, which is an outdoor mall, a luxury mall. And this place is minutes away from there. It's actually very close to our UTSA property as well. It's exactly a 3 or 4 minute drive from the UTSA hotel. So this property was originally built as an Omni hotel in 1985. And as you may know, Omni is a luxury brand. It's a more premium brand than the Westin. Then it was renovated in 2021, partially renovated, and it was converted to the Westin brand in 2021. In total, we have about almost 253,000 square feet of space, which is a lot of space, a lot of rooms. And we have all these incredible amenities like, meeting and events. We have a ballroom for 1,500 people. We have a restaurant, a lobby bar, a pool bar, and a coffee shop. And funny enough, only the lobby bar is being operated currently. Everything else is not being operated. It's shut down. The restaurant is shut down. The pool bar is old and tired. It doesn't get used. And the coffee shop doesn't exist either. You can order food. There is a functioning kitchen, but you order the food at the lobby bar, which is pretty sad considering this is a full service property. But it's good for us because it's more value add opportunity. And let me go to the next slide. So this is the property. Like I said, so there's an interesting story about this property. It was built in 1985. In 2021, in the height of the pandemic, as you may recall, the hotel business was not very good. It was terrible. Domestic demand was at its lowest, probably all time since the last pandemic. And it just was not a good time for the hotel business. And during that time, Marriott was very aggressive and sorry, very bullish on San Antonio. And they convinced the owners that converted it in 2021 to let them have this property and put a Westin flag on it. And because these were special circumstances during COVID, they were able to negotiate a special exemption. Typically, when you convert a property, you got to do everything. They give you a very strict criteria. They give you a list, and you got to go down the list. You got to do the rooms, the lobby, the bar, the food options, the restaurant, the convention center, everything, outside signage, everything. But for this specific property, they got a special permission from Marriott to do a delayed PIP. They made a special deal. Marriott said to the hotel operators or the owners, just do the lobby, make it look like a Westin, do the convention center, so at least you start getting some corporate bookings and whatnot. We'll give you 5 years to do the rooms. This never happens, okay? So this is a strange phenomenon. I've never seen this in my life. You enter the property, it looks like a Westin, you check in, you take the elevators up. The moment you step out of the elevators, it feels like you traveled back in time and you ended up in a completely different property. The carpets are off-brand, the furniture is off-brand, the colors are completely different because it still has the old Omni rooms and hallways. So that is a major renovation. It's a major upgrade that needs to be done. And these guys ran out of time. Not only did they run out of time, but they happen to be coming up for a renewal on their debt, and it's not feasible for them to do this anymore. That's why they're letting it go for a ridiculously low price. So this is the investment summary, and just to talk about this a little bit, the replacement cost is an important metric that we follow in the hotel business because we're selling rooms by the night, and every room is a revenue generating unit for us. So we ask ourselves, what is it going to cost us to build a similar property and acquire 326 rooms, a full service hotel? What will it cost us to acquire that or from scratch if we were to build it from scratch? Typically, right now, the replacement cost on a property, and I'm going to come back to this slide. The replacement cost on a property like this is anywhere from 400,000 to $700,000 a year. Oh, sorry, a room,
Per room.
a room, a key per key. So, and I have some real examples to show you in a second. Our basis, we are able to acquire this property at $55,000 a key, which is unbelievably low. It's unheard of. Of course, partially the reason why that is so cheap is because it needs a lot of love. It needs upgrade. The rooms need to be upgraded. The lobby needs to be redone. All these revenue generating departments are closed. The restaurant is closed. The cafe, it doesn't exist. All this stuff. So that's the reason why we're able to get it for so cheap. But even with our budgeted property improvement plan of $15 million and reserves and closing costs, our all-in basis is about 103,000 a key, which is so cheap. I mean, if you have any multifamily investments, if anybody here has worked with multifamily operators, you'll know that anytime you're getting something for less than $200,000, that's considered a good deal. In this case, $103,000. And just to give you a couple of examples of some comparisons in our market in San Antonio, we have a couple of examples here. So there's this Intercontinental Hotel at the Riverwalk, which is a full service property. It's a beautiful property. I've been there many times. It's a similar brand, right? The Westin and the Intercontinental are neck to neck when it comes to the brand standard and level of luxury. They did a renovation and it cost them 405,000. That was the number that they came in at, $405,000 per key. Mind you, it may have been done in a very expensive environment like COVID, where everything was ridiculously expensive. But that's the comparison. There was a property that was built in San Antonio, the Monarch. Their cost was $925,000 a key, which is crazy to me. For me, that's I don't know how they spent that money, but it's a lot of money. But it is a luxury property, a more upscale property than or upscale brand. Okay. And here are some more examples. So we have the Monarch, and they all have different number of keys. The Monarch has 200 keys. The Intercontinental has 390 keys. Is a $158 million project and 405,000 a key. There's a JW Marriott at the Riverwalk, 164 million. Of course, the JW is a more premium brand, but 545,000. And then there's this Hilton that's being built right now. And this is not a fair comparison, but just to tell you how good our deal is, this Hilton Garden Inn, it's a select service property. The Garden Inn, the Home Two Suites, there's a seven-story property coming up in the medical center, which is two select service flags in one property. This is a new trend in the hotel business. You'll see dual branded hotels. And their cost is about 240,000 a key, new construction. Okay, which is it's okay, but it's a little high for select service, but we're coming in way under that. Okay. So I'm gonna go back. Here we are. So what makes this the perfect storm? We have significant upside once we complete the PIP. We have a very attractive basis going in. And as you know, the money is made on the buy, right? If you buy something right, whether it's a house or real estate or a car, whatever, you've made money. Okay. Uh, it's an institutional grade uh, acquisition, and the brand, because it's a full service brand, it's an institutional quality brand that when it comes to later on, if we want to exit, we'll have plenty of buyers, the big giants from Wall Street that'll be interested in this. We're located in a high growth market, the sixth largest city in the nation, which is about to take off. As I mentioned, a lot of people are very bullish on San Antonio. A lot of people are overlooking San Antonio, but quietly it's heating up and it's becoming a center of growth. And of course, I talked about the airport. There's a lot going on here. Okay. To summarize for our investors, the investment summary, actually, before I talk about this, let me just show you our underwriting. Okay. So I have an Excel sheet here, which basically shows us the way we've underwritten this. There are three scenarios: a very conservative scenario, a very sort of a middle of the road base scenario, and then there's an optimistic scenario. Currently, the property is doing, last year, it did $13 million in revenue. Okay. It's on track to do $15 million this year in revenue. And that's a number that was provided to us by the sellers. We are assuming that for year one and year two, we're just going to do the property improvement plan, get to work. We're going to have to block off floors at a time to get to the rooms right away eventually. So what we're going to do is we're going to do the rooms. We're going to activate the food and beverage, the restaurant, the bar in the front, which we're going to convert completely, and just keep things status quo. Try to minimize the expenses, run it leaner, way leaner than the current owners. And by the way, the current owners are a large institutional group, and they're not doing so well because this is at the very bottom of their list of priorities. They have way more attractive and sexier properties than this, and that's what they focus on. And they look at this as a dog. They say this is not worth our time. Just keep it status quo until we sell it. So we believe if we come in, we do the upgrades for year one and year two, we maintain status quo. Year three, we start ramping up and we start aggressively marketing. We activate all the departmental revenues. As you know, in the hotel business, there's room revenue, there's the F&B revenue, food and beverage, other departments like valet and laundry and things like that. And together they add up. And of course, there's also the convention center revenue. So we believe that in a conservative scenario, we can expect the revenue to reach $19 million. Okay. In a Fair, a base middle of the road scenario, $23 million in revenue. And a
Raza,
very,
show the net operating income on the
I will,
conservative.
I
Oh,
will.
okay.
So the net operating income, $5 million in a very conservative scenario. By the way, that is so conservative because I can tell you our Staybridge Suites in Laredo, which is a select service property, that property is doing close to $4.7 million, $4.5 million in net operating income. Okay. So this is something that's dependent heavily on the operator. And the middle of the road scenario, $7.2 million net operating income in year five. And an optimistic scenario, $10.9 million in NOI. Now, to tell you something, which is very cheeky, what these guys are doing right now, this Westin is currently being rented for $84, $85 a night. Would you believe that? When was the last time you stayed at a full service hotel like a Marriott or a Westin or a Sheraton or a Hyatt Regency for less than $200 a night or $250 a night? Maybe you get lucky, you pay $180 a night or $150 a night, but 85, that's a price for a Motel 6, not for a Westin. So, and they're doing that because they want to keep the occupancy. They want to maintain occupancy, and that tells us the moment we do the renovations, we convert the rooms to the new Westin brand standards, and we upgrade the property. We'll be able to charge significantly more what the property should be charging, which is $250 or $300 a night. And of course, when you have all these people coming in, they spend more money within the property. They go to the bar, they go to the restaurant, especially the corporate guests that are coming for conventions and conferences. They have expense accounts and they need a place to use their credit cards. And we believe that we can transform this into a world-class select a full service property in San Antonio because clearly there's a demand. Going back to the presentation, this is what it looks like for the investor. We have two share classes. If you want to participate in this, there's a share class A1, then there's a share class A2. The A2 share class starts at 350,000. That's the minimum investment. Share class A1 has $1 million minimum investment, and you can expect an IRR of about where's the number? 27 to 35%. That is the annualized return, the IRR that we're projecting. Okay. In year one and year two, we're telling our investors do not expect a distribution right away because it's going to take us some time to stabilize this property because it needs a lot of work. And while we're doing the work, the property blocks of the property will be shut down. We just don't want to put pressure on ourselves. We'll make it up to you later. There's plenty of meat on the bone in this property. The distributions are 12% preferred in starting in year three. Year three, year four, year five, you get a 12% preferred distribution. And of course, the equity uplift is very significant. And we're assuming a 9.5% cap rate scenario. We believe like I said, our all-in basis going in is about $33 million. We're putting $2 million and change in a reserve fund for a rainy day if we need it. This way, we don't have to do any capital calls. And we believe this property is going to be worth north of $80 million, hopefully close to $100 million if the market picks up again, the Fed rate comes down, people start buying all of a sudden. That's what it looks like. And of course, just a couple of things to talk about. People may ask this question, what is the investment structure? So it's a GP-LP structure, which is where there's a general partner and a limited partner. Every dollar we raise, we're raising about $19 million in total. We are raising through our fund entity, which is Qila Fortress Fund 1. Because we're a regulated company with the SEC, we have to raise money through the special vehicle. And that the 100% of the money that people invest in for this deal will go to the lower tier entity, which is the limited partnership. And then, of course, the limited partnership has a 49, 51% structure with the general partner, which is us, Qila Capital. And this is the most above board and legal way of doing it. It protects our investors by the regulations of the SEC. And of course, it also creates a liability wall where no liability flows over to the investor. The general partner does all the heavy lifting, including the operations, including the management of the property, the financing if necessary, anything at all. And all the good stuff flows to the investor. The capital, the profits flow to the investors, and the depreciation, the tax benefits also flow to the investors. Okay. I know we are getting close to the end. I apologize. I'm running a few minutes over. Now, the best part is, as a participant in this deal, you'll be getting access to the MMP discount code. This is the most coveted discount code in the world of hotels. If you travel a lot for work, or if you travel for leisure with the family, with the wife, and you're used to paying $300 or $250 for a Westin or a Marriott. Now you can spend the same amount of money and stay at the Ritz-Carlton, which costs $1,300 a night typically. Okay. You get up to 70% off at any Marriott Bonvoy property around the world, and there's over 10,000 of them ranging from all these different brands, the Ritz-Carlton, the JW, the W, the St. Regis, you name it. This is a very nice little perk that people love. And of course, you have access to this unlimited access. Use it as much as you like, uncapped. Okay. I'm not going to talk too much
Uh,
about this. We have some,
Brett,
go ahead.
let me say a word. I myself, I'm an older investor, so I don't have a long runway ahead of me. But I like this Westin project because we have kind of a 5-year focus to reevaluate our position in 5 years and determine, do we flip it, cash out? Do we refinance and distribute some of that money to our investors? Do we do 1031 exchanges into something bigger and better? But I like the idea that this isn't something like my Cheyenne investments that I invested in 2008, and I'm still here 20 years later. I don't have 20 more years ahead of me, and I don't know about you if you're an investor, but I like the idea that there's a short window here where something could happen, and then this isn't a lifetime commitment.
That's right. Absolutely. So the standard exit, to speak to this point, is about 5 years, but it's optional. So we are not going to be exiting this entirely. We're not going to sell this hotel in 5 years just because we see so much potential in this, and we believe it's going to turn into a cash machine. But because we're required by the SEC to place an exit for our investors, we're telling our investors there's a 5-year exit timeline. During that time, we may sell if the right opportunity, the right buyer comes along, or we'll refi it and we'll refi the investors out. We'll give you your profits and your principal investment back, and you can reinvest in. You can take the money and take it out, or you can reinvest it into another deal, whatever you like. So that concludes the presentation. At this time, we will do a Q&A session. Thank you so much for your patience, guys. I really appreciate it. I know it's late in some places, like the East Coast is 8 o'clock now. So thank you so much for your patience. At this time, I will stop sharing my screen. And if you have any questions, please go ahead, and you should be able to ask a question at the very bottom. It should give you an option to do so. Is there a section for Q&A? There we are. Some questions are coming in already. So there's a question. The total acquisition cost is 35.6 million with the GP equity 50%, but the total raise is listed as $19 million. So yes, the way that the numbers are calculated, the reserve fund and the closing costs are added on top of the 50%. Okay, because the reserve is the reserve funds will go back to the limited partners after the deal. Okay, so the reserve fund just sits in an account in case there's any need for it, and all that money goes back to the limited partnership at the end of the 5-year term. The second question is What exactly does a sponsor's economic come from if there are no GP fees? Okay, is the entire 51 ownership stake or is there a promote carry structure on top of that? So the way that it's calculated, we charge no fees of any kind. The sponsor's economics are the investors get, so before the actual investment, there are no fees and there's no double dipping of any kind off the top. No management fees, no acquisition fees, no disposition fees, no PIP administration fee, which is some sponsors do that as well. The way it works is it's a peer partnership model. The investors get paid first. The investors, 100% of the profits go to the limited partnership until they have received a 12% preferred distribution. And then after that, the GP is entitled to earn the upside until it reaches a 50-50 scenario. So in the event that the property generates net margins, net or gross distributions, let's say 15%. 12% goes to the investors, the limited partnership, 3% goes to the general partner. That's how we make money. And in the event that the gross distributions are above 50%, or sorry, above 24%, at that point, there's a reverse carry that goes to the limited partner. So you get your 12% plus you make more if the property does 25, 26, 27%. It ends up being a 50-50 split between the limited partner and the general partner. So you get a 12% preferred distribution or 50% of the profits, whichever is greater. Okay. There's no promote or other. And then of course the capital event is paid out in two different ways, depending on the share class, up to 50%, and the other one I think is 35%. Just because this deal is very value add intensive. Okay, there's a lot of upside to be made. Another question: what is the actual timeline to close? We're projecting to close next month in around the 20th of August. There's a chance that it may get delayed just because we're under due diligence, and this is the biggest due diligence project that we've ever done. And there's a lot that goes into closing on a big hotel like this. We're walking every room. We're making sure if there are any defects, they're accounted for by the seller. For example, there were a couple of small leaks that we found in the roof on the top floor, I think, or the 16th or 15th floor. And now those need to be addressed by the seller before we buy it. We had to do a property inspection. We had to do a phase one environmental inspection. There's all kinds of stuff. And of course, we have to underwrite the entire PIP. And we have to underwrite the entire financials to make sure that whatever the seller is providing us is accurate. Okay. Can we cover the questions? Yes. So we've covered those questions. What is your contingency plan if the PIP runs over budget or over timeline? Is there a capital call provision and how much is funded? So we have been extra conservative in our underwriting. We have accounted for all scenarios for the PIP. We believe that we're actually going to come in under on the PIP. So we're projecting 15 million for the purposes of underwriting this investment. We believe we'll be able to get it done for 13 million or less even. We have a lot of ways. One of the ways we save is the FF&E, which is all the carpets and furniture, fixtures, and equipment, as it's called. This is one way we save a lot of money. All the furniture, for example, we go straight to the source, get it from China. We negotiate with Marriott to let us use alternative suppliers, etc. So there is already a $2 million buffer baked into the PIP cost, plus there's a $2 million reserve fund. So in total, there's $4 million in reserves that are set aside, and that's 25% of the cost is accounted for. And if there is a capital call, we're not going to do a capital call. We hate it. I know a lot of investors have expressed this, that they don't like capital calls. I know that for a fact. We have enough liquidity. If there needs to be a capital call, the sponsor will cover that capital call, and we will not be requiring the investors to step in. Okay. Any other questions? Please don't be shy. I love talking, as you can see, because clearly I've gone over the 1 hour allotment. So if you have any other questions, please go ahead. Don't be shy. And what I'll do after this call, this webinar, is I'll send you a follow-up link. I will send you a calendar link if you wish to get on a call with me and discuss your allocation. We would be happy to discuss this with you.